Hello, very good evening, students. So, how are you? Hope so you're doing good. So, today we are discussing a very important chapter, non-resident taxation. From exam point of view, around 6 to 8 mark question comes in almost every attempt from this chapter. But from practical point of view as well, it's very important and relevant. I'll tell you, most of the big four practice revolves around this chapter only. So most of the whatever the Deloitte, PwC, the corporate taxation, whatever they does, the basics is this chapter, the non-resident taxation. They majorly have the work of non-resident MNCs only, which we will study in this chapter. So a thorough, a conceptual understanding of this chapter will help you to clear your big four interviews as well, from corporate tax point of view. Okay. So we have divided this chapter into 5 lectures. So this is very important chapter, and we'll cover in 5 lectures. And we'll start with the basics and slowly move to the advanced stage. Okay. So in today's lecture, we'll only discuss the residential status. We all have studied the residential status of individuals and other entities in our IPCC exams. We'll discuss that also, not in much detail, but we will like to go somewhat little deep in respect of interpretations, and then majorly we will discuss the residential status of a company, the poem, which we have not studied in the IPCC exam. Okay. So first of all, friends, let's start with the basics. First, tell me why we study this residential status. What is the relevance of residential status? Try to keep the class interactive. It will help you to maintain the focus in the class. है ना? So I'll try to revert to the whatever message you give in the chat. So can anybody tell me what is the relevance of residential status? Why we are required? Why we are supposed to compute a residential status? I'll tell you. See, the ultimate aim is to compute the tax liability. Tax liability, right? What tax liability? I must know the income. And to determine my taxable income, the taxable income of assessee, there comes the concept of residential status. Because depending upon the residential status, the taxable income of the assessee varies. If a person is a resident in India, then the nature of income which is taxable in India will be different from the person who is non-resident in India. I hope we are clear on this, and you know till that. Okay. So see, why this residential status is important is that every government wants to tax everybody for every income. Of course, every government wants to increase their tax revenue. But take an example. Can India tax someone, say Mr. John, who is born and brought up in US, working in Microsoft US, driving salary from Microsoft US, which is received in his US bank account? He has no whatsoever connection with the India. Can Indian government say, Mr. John, that you pay tax on your salary income to the Indian government? Can it say? It can say, but what would be the reply of the John? John said, I will not do whatever you can do. Can India do any harm to the John? Answer is no. Why no? Because here comes the concept of nexus. India does not have any nexus with Mr. John. Nexus means connection. India does not have any connection with Mr. John. If Mr. John doesn't pay the tax, India cannot force him to pay the tax. Why? Because Mr. John does not come within the jurisdiction of India. Now, what does this mean? Jurisdiction means India doesn't have a jurisdiction or a right over the income or over Mr. John as a person. So what I said, neither India has a right over the income of Mr. John, nor India has a right over the Mr. John as a person. So what I'm trying to say is that Nexus is built either as a person, either India has a connection with you as a person, or either on the income which you are driving. Okay. So assuming Mr. John is a resident in India, then India, of course, can enforce the levy of tax on Mr. John. Why? Because now India has a control of Mr. John because he's a resident in India. He must have an asset or something in India. So India has a control over the assets. So India can recover tax from such assets. So firstly, the nexus is built to a resident. So what the law says, if you are resident in India, then your global income is taxable. I am not concerned whether you're driving income from India or from outside India. But since Nexus is built for a person, then your global income is taxable. But even if you're not a resident in India, but if you are driving income from me, from India, then also your income is taxable in India. So if you're a resident in India, then your global income is taxable, whether it's derived from India or derived from outside India. But if you're non-resident, then also your Indian income is taxable. Why? Because I have a control over your Indian income. Yeah? Why this tax is levied on Indian income? Because government says you're using my economic resources to drive an income, so you must pay a portion of it to me as a taxes. Understood? So here comes two types of taxation. What we call residence-based taxation and source-based taxation. Residence means if you're a resident of a country, then that country has a right to tax you and to tax your global income. So in case of resident, normally the global income is taxable. Source means if the income is deriving from a country, the source of income is in India, then India can tax that income irrespective of the fact whether you're resident or non-resident. Okay. So what follows? If you are resident, then your Indian income is taxable. Your foreign income is also taxable because Nexus is connected with you as a person. But if you are NR, then only your Indian income is taxable. Your foreign income is not taxable. Understood? You are with me? So the concept of residence, whether you are resident or you are non-resident, is relevant only for this. You see, for the Indian income, their tick is for both, whether resident or non-resident. So if there is an income which is an Indian income, it's taxable in the hand of resident as well as non-resident. So for that, I am not required to determine, to ascertain whether the person is a resident or non-resident. You are with me? Say, if Mr. A is earning an income from India, whether that income is taxable or not is not dependent upon the residential status of Mr. A. Even if Mr. A qualifies non-resident, still that income is taxable. Why? Because income is derived from India. It's an Indian income. So Indian income is taxable whether you're resident or you're non-resident. The concept of residence status is important only for foreign income. Because foreign income taxable only in the hands of resident and not taxable in the hands of non-resident. I hope you're understanding the concepts. Okay. So first thing is why we are studying resident status? To determine the taxability of this foreign income. Now tell me one thing. As an assessee, what would you prefer? Would you be prefer to be a resident or non-resident? Tell me what an assessee would like to be. Either would it like to be a resident or would it like to be a non-resident? I'll tell. Of course, he will like to be a non-resident. Why? Because assessee, what does assessee want? Assessee wants the reduced tax liability, the reduced tax bill. Okay. And in case of non-resident, the foreign income is not taxable. So tax liability is reduced in case of NR. So government, the assessee always wants to be a NR. By this, his foreign income derived from outside India is not taxable in India. But what the government will want? Similarly, government will want to increase its tax revenue. So government will want every person to be a resident, because by then the entire income of such person shall be taxable, whether derived from India or derived outside India. So you understood this concept? Now, a small concept. When I say that income derived from India or an Indian income is taxable, whether you are resident or non-resident, what do I mean by Indian income? Can anybody say? I'll tell you. The Indian income means the income accrue or arise in India. This word you have heard a lot of time. Accrue or arise. You are studying this from IPCC. Can you tell me the meaning of this word? When we say that income is accruing or arising in India, what factor determines where the income accrue or rise? I'll tell you. The income accrue or rise where the activities to earn such income is performed. To earn such income is performed. Okay, I'll give you an example. Say there is Mr. A who is working with Microsoft Inc. in US. Okay, he came in India in May 2024, and he opted for work from home from Microsoft US. Okay, so he worked for the month of May from India while sitting in India for Microsoft US. He received the salary for the month of May in his US bank account, of course. The question comes whether the salary of this month, the salary he received in the US bank account for the month of May 24, whether this salary is taxable in India or not, assuming for the fact that Mr. A is a non-resident. See, now I am asking you to answer me whether this salary, can we say that it accrue or rise in India or not? The answer is yes. Why? Because the activity to earn that income was performed in India. And therefore, this salary income is deemed to is actually accrue or rise in India and should be taxable in the hands of Mr. A, subject to other provisions which we will study in different lectures. It accrue or rise in India should be taxable in the hands of Mr. A till the point we studied here. Because the services were rendered while he was physically present in India. The fact that he rendered service to Microsoft Inc., which is a foreign company, he received the amount from a foreign company in a US bank account outside India, is not relevant at all. For determining where the income accrue or rise is, the relevant factor is where the activities are performed. You with me? Okay. There is one more concept of Indian income. So what I told you, Indian income means income which accrue or rise in India. Also, it includes an income which is received in India. So the government has widened this concept to include an income which means accrue or rise in India. If activities are performed in India to earn such income, then such income is taxable in India, irrespective of the residential status of the recipient. And or even if the activities are performed outside India, but such income is received in India, then such income is also deemed to be an Indian income and taxable, irrespective of the residential status of the recipient. Understood? Okay. So for this Indian income, we are not concerned about the residential status. But when the income neither accrue or arise, nor is received in India, that income is called foreign income. And whether this foreign income is taxable in India or not, only for this limited extent, we are studying residential status. Whether this income is taxable or not in India, only to ascertain that such a limited scope of this chapter, residential status, is that whether this foreign income is taxable in India or not. Here with me? Now we'll quickly discuss the residential status of individual. You have already studied this in your IPCC. I brush it up. Sorry. How we determine the residential status of individual? You remember there are two types of condition. One we call basic condition, the additional condition. We will discuss everything. So law says basic condition is that a person, an individual is resident in India if he stays in India during the relevant previous year for 182 days or more. So if a person is physically residing, if the individual is physically present in India during the previous year for 182 days or more, then such person is called resident in India in that year. See, the concept of residential status is a yearly concept. A person may be resident in India in year one, he may be not resident in year two. So we have to check the residential status in every year. Okay. So how the government has aligned the residential status? What's the nexus? The nexus is stay. So irrespective of the citizenship, nationality, whatever, that's not relevant. What is relevant is physical stay of the individual. If the individual is physically present in India for 182 days or more, at least 182 days in the relevant previous year, then we say he is a resident in India. Here with me? The second condition is or means alternatively. Either he satisfies this condition, he stays in India for 182 days or more, or if he is in India for 60 days or more during the relevant previous year, the previous year for which we are ascertaining the residential status, and he was in India for 365 days or more in the last immediately preceding 4 previous years. So, if Mr. A satisfies condition 1, he was in India for 182 days or more, then he will qualify as resident in India. If he was in India for less than 182 days, but he satisfies condition 2, which is he was in India for 60 days or more, and in the last 4 years, he was in India for 365 days. Then also he will qualify as a resident. For first condition, we just need to see the presence of the individual in the relevant previous year. In the last preceding previous year, whether he was in India or not relevant. If the person is in India for 182 days or more during the relevant previous year, then he is resident. But if it's less than 182 days, then we shift to the second condition. Then we see whether he's in India for 60 days or more during the relevant previous year. If answer is yes, but you have to see his stay in the last 4 years. If the aggregate stay in the last 4 years is 365 days or more, then also he can qualify as a resident. I hope you understand all this and you remember all this. Okay. What we mean by stay? I'm just doing this fast because this is not much important from exam point of view, and we'll focus on the more important area. Okay, this you have already studied, but still I'm trying to capture everything. So what do you mean by stay? Stay, is it required that stay has to be continuous? Answer is no. You can come, go during the relevant previous year. If the aggregate number of days during the relevant previous year exceed the threshold, 182 days or 60, as the case may be, then you will qualify, you will satisfy the condition, you qualify resident. Hope I'm clear. So first condition is it's not required that stay must be continuous. Okay. Whether it's required that stay has to be a fixed place at a place in India? No. At once you can stay in Delhi, then Kolkata, then Bombay, wherever. Even if you stay in the territorial waters of India, which is 12 nautical miles from the coastline, then also it's deemed that you are staying in India. Okay. So what's relevant? Actual stay. Whether continuous, whether fixed place, not relevant. Lastly, if you come on 1st of May 24 and the flight lands the Delhi airport, say 11 p.m. and you returned to your US on the 3rd May 24, and the flight took off at say 12:01 a.m. in the night on 3rd. So you landed on 1st May 11 p.m. So you were there for an hour on 1st May. Then for you were there for entire 2nd May. Then 3rd May, you were there for a minute only. And the flight took off on 12:01. The question is, how many days you were present in India? The answer is 3 days. The day of arrival and day of departure shall be considered as a day stay in India, irrespective of the time. So even if you are there for a minute in a day, it will be deemed that you are in India for the entire day. Okay, quite simple. So what are the basic conditions for individual to qualify the resident in India? He has to be in India for 182 days or more, or he has to be in India for 60 days or more during the relevant previous year, and in the last 4 previous years, he has to be in 365 days or more. Okay, aggregated. Now tell me, if I say there are 3 categories of person for whom the second condition is not applicable, can you tell me whether this is a benefit which is provided to these person, or this is something a penal provision for these type of person? We'll discover who all these type of persons are. But first tell me, if I say there are 3 types of person, A, B, C, these persons shall qualify as resident if they satisfy the first condition, which is 182 days or more. Is it a benefit provided to them, or is it a penal provision for them? See, if ABC can qualify as resident only if they satisfy the first condition, meaning thereby, if they are in India for less than 182 days, they will not qualify as resident. They will not qualify as a resident. So, their foreign income shall not be taxable. What I told you, the assessee wants to be NR. Yeah? So, the possibility of their becoming a resident is reduced. Now they have to satisfy only one condition. They are not bound by the second condition. So, this is a benefit which is provided. Now, who all are these 3 types of person? You know very well. An Indian citizen who leaves India during the relevant previous year. Why? For employment outside India. For doing a job outside India. So, if an Indian citizen leaving India for employment outside India, then the year in which he leaves India, he has to satisfy only condition number 1. If in such year he was in India for less than 182 days, then he will be a non-resident for such year. So this benefit provided only in the year in which he leaves India. Okay. So the second type of person is Indian citizen who leaves India during the relevant previous year as a member of crew of Indian ship. Member of crew of Indian ship. So if you're leaving India to join an Indian ship, then also only first condition shall be applicable to you, and you will not be governed by the second condition. Third, very important, you are either an Indian citizen or person of Indian origin, and you are settled outside India. You are being outside India, and during the previous year, you have come to visit India. Okay. So for all these 3 types of person, only condition number 1 is applicable, condition number 2 is not applicable. Right? Can you tell me who is Indian citizen? The Indian citizen means a person who holds an Indian passport. So first 2 conditions applicable only in case of Indian citizen. But third condition is applicable whether you are Indian citizen or a person of Indian origin. Who is a person of Indian origin? An individual is said to be a person of Indian origin if he, either of his parents, means mother or father, or any of his grandparents. Understood? If either of these person, any of these person were born in undivided India, then undivided India, then this individual is a person of Indian origin. So what it say? Either the assessee or his mother or father or any of his grandparents, if even a single person of this was born in undivided India, then the assessee is a person of Indian origin. If you see, I have used the word either with the parents, any for the grandparents. So why? Either means between the two, so the mother or father. Any means more than two. So for grandparents, it covers the four: the parents of mother and the parents of father, the maternal grandparents, and also the father, for the grandfather and grandmother of mother, the father and mother of your father. So there comes 4 plus 2 plus 1. Out of this 7%, if even a single person was born in undivided India, then that individual is the assessee is a person of Indian origin. The concept of person of Indian origin is almost outdated. If you see in your generation, neither of you nor your parents were born in undivided India mostly. So it's only that your grandparent might have born in undivided India before 1947. Your next generation may not be a person of Indian origin. Okay. So the third condition applies whether you are Indian citizen or you are a person of Indian origin. If you are settled outside India and you're coming to India for a visit, not for permanent settlement, only for a visit. Visit means you intend to go back. Then in such year, you will deem to be resident only if you stay in India for 182 days or more. Why are these benefits provided to these three persons? The benefits provided because these three types of persons are important. See, first person is important because he is leaving India for employment. He will generate the foreign exchange outside India and he will come back with the foreign exchange. It will increase the foreign exchange reserve. For similar reason, the third person is important. He is settled outside India. He must have accumulated a lot of foreign exchange. And if he come back after some year, he will bring a foreign exchange to India. Second type of person is important. Why? Because government wants people to join the Indian ship. So therefore, the benefit is provided to these three types of person. Okay. Yes, Miss Neha. Person with resident if grandparent dies who born in undivided family. Oh, I mean, you are saying the undivided India. Yeah, whether the grandparents are alive or not today is not relevant. If any of these 7% was born in undivided India, then the individual, the assessee, is a person of Indian origin. And the concept of person of Indian origin is relevant only for the third condition. Okay. Okay. So for individual, we have studied when you call us R or NR. But the story doesn't end here. When you call it NR, when you satisfy either of the two conditions, 182 days or more, or 60 days or more, and 65 days or more. But for the three types of person, the second condition is not applicable. Who are these three types of person? Indian citizen who leaves India during the relevant previous year for employment outside India. Indian citizen who leaves India during the relevant previous year as a member of crew of Indian ship. And lastly, the Indian citizen or person of Indian origin who visits India. Okay. Who being outside India visit India. But law says if you are an R, then you can either be ROR or RNR. Now, why this new concept? Yes, Mr. Sanjay. How is being resident in India beneficial? Can you please explain a bit? Of course, of course, of course. See, he's asking why being a resident in India is beneficial. No, I didn't say it's beneficial. Rather, it's not beneficial. Because if you're a resident, then your global income is taxable. Income earned outside India is also taxable in India. So assessee always want to be NR. Now his foreign income, the income accruing arising outside India and received outside India is not taxable. The government wants people to be beneficial. Why? Because if the people are resident, then their tax revenue will increase. But the assessee always want to be NR. So you see, whatever changes have been made. Yeah, that's what I understand. I thought you said it beneficial. No, no, okay. So it's clear now. If you see whatever changes have been made, and we'll study the changes which have been made recently, is to enlarge the definition of resident. So then more and more people fall into the definition of resident. Why? Because government always want more and more people qualify as resident. Okay. So the law says if you are non-resident as an individual, the story ends here. You are non-resident. Full stop. But if you are resident, then the story doesn't end. It says you have to see whether you are resident and ordinary resident or resident and not ordinary resident. Why this? Now, why this concept? You all know how we compute whether you are ROR or RNOR. But can anybody tell me why we compute this? Is it beneficial? Had it not been there, was it beneficial for the individual? Had it not been there, or it's in the favor of government? I tell you, it's actually in the favor of assessing. This is a benefit which the government has given. What the government says, what the thought behind this is that, say, take an example, here's a Mr. A who was in US since 20 years. He was working there. He had a family there. Now he worked there as an engineer, whatever. And now he has retired. And now he wants to come back to India permanently. Assuming for his financial year 23-24, on say 1st April 23, he comes to India permanently for settling in India. Okay. He wants to spend the remaining life in India with the family. So on 1st April 23, he permanently came back to India. Now for the financial year 23-24, he is in India for more than 182 days. So he will qualify as a resident in such year. Now we have studied that if you are resident, then your global income is taxable. But think for a minute, he was there in US for more than 20 years. He must have a lot of investment, house property in US. He was residing there for more than 20 years. So he must be driving a lot of passive income. There would be FDs in the banks of US from which he must be getting interest. There may be house properties in US from which he must be getting rent. And it is not possible to to sell off all this in a day. So if he comes in 2024, he will qualify as resident, and for the resident global income is taxable, then you will tax the entire passive income which is earning outside India. And US is also levying tax on such income because such income is accruing in US. So it's a discouragement for such person to permanently settle in India. So what the government does? Government said no. Now government wants all these people to come India because government wants foreign exchange. You have earned a lot of foreign exchange, you will sell and you will bring the dollars in India. So what the government say? No problem. This is the pain. I'll solve this pain. I'll give you 2 years to dispose of all these passive assets. 2 years a sufficient reasonable time. And for this 2 years, I will not tax the income your passive income derived from outside India. To give this benefit, the concept of ROR and RNOR were introduced. Now, let's see when you qualify as a ROR or RNOR. The law says if an individual is a resident, then we have to see whether was he resident in at least 2 out of 10 earlier years. Immediately preceding 10 years, you have to see was he a resident in India for at least 2 years, and not with and in the last 7 years, was he more than or equal to 730 days in India? If both these conditions, the conjecting factor is and, if both these conditions satisfied, then the person is called ROR. If even one of these conditions is not satisfied, then the person is called RNO. Okay. So take an example that we discussed. The Mr. A. Now he comes on 1st April 23. For 23, 24, he qualifies the basic condition. He was there in India for 182 days or more. So he qualifies R, but he does not satisfy any of these conditions because for the earlier 10 years, he was not a resident. And for the last 7 years, he was not in India. 730 days is not possible. So for 23, 24, he is RNOR. And for RNOR, the foreign income is not taxable. Now, let's say for 24, 25. Again, he qualifies resident. He qualifies 182 day condition. Now, the additional condition. For the last 10 years, he was resident in only 1 year, 23, 24. And for the last 7 years, he was in India for 365 days, 23, 24. Still, both the conditions are not satisfied, and he will qualify as RNOR. I hope you are with me. Now, for this year as well, the interest and the rental income he's deriving from US is not taxable in India. Now comes the next year, 25, 26. He qualifies R because he is in India, he's permanently settled in India. Whether he was resident in at least 2 years out of the last 10 years, yes. He was resident in 24, we just saw, and 24, 25. So he satisfied the first condition. In the last 7 years, his stay in India was 730 days. Because in 2024, he remained for 365 days. That was 366 days, I think. 24 was a leap year. And for 24, 25, he was there in 365 days. So he satisfied the second condition as well. So for 25, 26, he becomes the ROR. And in 25, 26, his global income shall be taxable. So in 25, 26, the rental income, which is driving in US, shall be taxable. I hope I'm clear. So government actually give you 2 years to dispose of your passive assets. And for these 2 years, the income accruing outside India, income derived from outside India is not taxable. So for this reason, the concept of ROR or RNOR was introduced. Had it not been there, had the individual was only classified as resident or non-resident, then in such case, Mr. A was liable for taxation on the US income from the first day itself, from 1st April 23. Okay. So intent to do the residential status of individual is only to give you the understanding of the concept. I know you know the condition, how it's computed, but to give you a better, deeper understanding, we are discussing this. But he would also get DTAA. Of course, he will get DTAA. That's Sanjay asking he will get DTAA. But even in DTAA, you have to pay the maximum tax. What a DTAA does is DTAA is the double taxation what is agreement. It says the resident country will give the benefit of the will give the credit of the taxes paid outside India. But the assessee is actually required to pay the higher of the taxes. So if you ignore the DTAA, if you go for the domestic taxation, even in the domestic taxation, the law doesn't impose the liability on you. So there is no question of doubly tax income. DTAA gives a benefit only in respect of doubly tax income. The income has to be doubly taxed. So the domestic law, the act itself exempts that income. So there is no question of DTAA as well. Good, Sanjay. You got a good point. Okay. So we discussed when you qualify as a resident, an individual or non-resident, and if you qualify as a resident, then you have to see whether you are ROR or RNOR. Okay. So the law was only up to this till 2020. So law from 1961 to 2020 was only limited to this, but we have studied. In 2020, some radical amendments were introduced in the Section 6, residential status. Government expanded the residential status. So what was these amendments? First amendment was, there are two types of amendment. The first amendment was in respect of third category of person. You remember the person who qualifies as an Indian citizen or person of Indian origin who visits India during the relevant previous year. So being outside India visits India. Okay. What the government said is, what the rationale of the government, which the government said, is that what these people do is they have a business which is controlled from India. Now this is a new term. What does this mean? Controlled from India. I'll tell you in a minute. So what the government said that these people have a business which is controlled from India. They come into India to control that business and they stay in India for 181 days every year. So if you stay in India for 181 days every year, they consciously plan their affair in such a way that they don't cross the threshold of 182 days. You will qualify as NR because I'm this type of person. The second condition is not applicable of 60 and 365 days. So you qualify as NR and the income from this business is not taxable in India. Now, why is not taxable? First, let's understand what do you mean by business control from India. See, so business control means the decision for such business are taken from India. I tell you. Take it for an example of maybe Vivek Oberoi or somebody, a builder who builds housing in Dubai, an Indian. Okay. So he's a builder who builds a house in Dubai and sells the houses in Dubai. Okay. So the business of this builder, the building of houses and selling the houses, the income from such business accrue or rise in. Tell me where? I told you. The income accrues where the activities are performed. So income is accruing outside India, in Dubai, because the houses are built in Dubai. But the decision to build the houses and all important decisions at the price at which it has to be sold or whatever are being taken from India because the person is actually sitting in India. The activity is performed outside India, but the decisions are taken from India. So this is a business from which income accrues outside India, but this business is controlled from India. So for deciding whether income is taxable or not, what is relevant? Relevance is where the activities are performed. So for non-resident, this income is not taxable because the activities are performed outside India. The income does not accrue or rise in India. But government says this is a pain point. You're having a business which is controlled from India and you manage it in such a way that you don't pay tax on such business in India. Manage your affair in such a way by staying less than 182 days. So what the government said is that for the third category of person who visits India, you have to divide them into two parts. You have to see their Indian income. If their Indian income is less than equal to 15 lakh or more than 15 lakh. If their Indian income is less than equal to 15 lakh, no change. They will be resident only if they qualify as a first condition number 1, which is more than equal to 182 days. But if your Indian income is more than 15 lakh, then you will qualify resident either you stay in India for 182 days or more, or you stay in India during the relevant previous year for 120 days and 365 days in the last 4 years. So either of this condition if you satisfy, you will qualify as a resident. So the provision for enlarged, the widened. Now this person having an Indian income more than 15 lakh shall qualify resident even if they stay for 120 days or more in India than the relevant previous year. Say, take an example of that person who was staying in India for 181 days every year. Now he will become resident. Why? Because he will there 120 days in the relevant previous year and the last 4 years he is more than 365 days. He is staying for 181 days in every year. So he qualifies this condition and he will become a resident. Now tell me whether this person would be ROR or RNOR. So this person would be ROR because he will qualify resident in all the year So in last 10, 2 out of 10 years, he's resident. In the last 7 years, he's more than 730 days. He's staying for 181 days every year. So he will be qualified as ROR. By qualifies ROR, his global income shall be taxable. But you remember this was not the intent. The intent was only to tax the business which is controlled from India. So what the law says, if you are becoming a resident because of this condition, because you are in India for 120 days or more, but less than 182 days. So you are becoming a resident because of this condition, second condition, then you will always be RNOR irrespective of additional condition. So you need not to check the additional condition, whether you satisfy or not, you will always be RNOR. So what's the beauty? For RNOR, the income from business control from India is taxable. This is the precise difference between the RNOR and NR. Okay. The next amendment was, we are doing it fast because I understand you know this. The government brings the concept of deemed residential. What is deemed residence? Government says if you are an Indian citizen, mind it doesn't apply to the person of Indian origin. So if you're an Indian citizen and you have Indian income more than 15 lakh and you're not liable to tax in any of the country, not liable to tax, then the government will deem you as resident. Understood? So, why this concept was brought? This concept brought to bring into a tax net stateless persons. Who are the stateless persons? Stateless person means the person who are not liable to tax in any of the country. See, what happened is that the income tax law is primarily the same throughout globally. Okay, that's why the Indian CAs are able to practice in outside India as well. So depending upon the peculiar differences related to the nation, otherwise the broad setup of the law is same. So in every country there are a number of days by which if you stay there for more than that, you qualify as resident. So what these people do, these people are normally HNIs. We are talking about the film stars, the business tycoons, or the sports personalities. They manage their affairs in such a way they don't qualify as a resident in any of the country. So their global income is not taxable in any of the country. Indian government doesn't like that. Indian government said if you are an Indian citizen and if you're not resident in any of the country, then I will deem you as a resident. So they are called deemed resident. And if you see, the condition here is you should be Indian citizen, your Indian income should be more than 15 lakh, you should not liable to tax in any of the country. There is no condition of stay. Even you don't stay for a single day in India, still you can satisfy all these three conditions, you will deem to be resident. Okay. Here also, you understood the concept? Here also, you will deem as RNOR. And one more important thing, the deemed residency concept applies only if you qualify as NR under section 6.1. That is a basic condition. Because if you see, you take an example of any person. Say, take an example of me. I am an Indian citizen. I have an Indian income more than 15 lakh. I am not liable to tax in any country outside India. So I satisfy the condition of deemed resident. I qualify deemed resident. And thereby, I qualify as RNOR. But I being in India since birth, I should be ROR. So it's a benefit for me. So there is overlapping. So the law says, first you have to check section 6.1. If you qualify as NR there, then come to deemed residence. Then you may qualify as a deemed resident. Otherwise, if you qualify as resident 6.1, then the provision of deemed residence not applicable. Okay. Lastly, small concept. When I'm saying Indian income more than 15 lakh, what do you mean by Indian income? Indian income is defined negatively. Indian income means the income which is not a foreign income. And what is foreign income? So say foreign income means an income which accrue or arise outside India, except from a business controlled from operation set up in India. Okay. So the income from business, remember Dubai business? Income from business which is controlled from India is actually accrue outside India. But that will not be treated as foreign income and that will be added as part of India. Okay. So more or less, this was our discussion, our concept on the residential status of individuals. Residential status. Any doubt, you can perfectly, freely ask. I hope you have already shared this. Sometimes questions are asked from this concept as well. Yeah. One very small concept in this only. A benefit is provided to an Indian citizen who joins a ship. So it says, the law says, if you are joining a ship and a ship is on eligible voice. What is eligible voice? Eligible voice means the ship is roaming in the international traffic. Means either the starting the starting port is in India, then the destination port must be outside India. Or if the starting port is outside India, then the destination port must be in India. So if the ship is such which is roaming in the international traffic between India and outside India, then if you join as a crew member of such ship, then the following period shall not be deemed to be stay in India. Which period? The period starting from the date mentioned in CDC, Continuous Discharge Certificate. It's a certificate which is provided to every crew member. It has all the details while he was in the ship. So he joins the ship as per the date mentioned in CDC. Up to the date he leaves the ship as the date mentioned in this CDC. So this period is deemed to be he was not staying in India. Not staying in India. Not staying. So you have to see his stay excluding this period. Okay. So this was all about the financial status of individual. Now let's see some questions. There are some questions in the book. Okay. So we'll cover the question from the module. Plus past year question plus RTP plus MTP. We'll cover all these types of questions in respect of this chapter in the class itself. So if you see question number 1, Mr. Ajay is an Indian citizen, a member of crew of a Mauritius-based Indian ship. Wait. Mauritius-based Indian ship engaged in carriage of passenger international traffic, departing from Mumbai port on 16 July. From the following details for PY 25-26, determine the residential status of Mr. Ajay for AY 26-27. Assuming that his stay in India in the last 4 previous years, preceding PY 25-26, is 415 days and last 7 previous year is 745 days. So what the table says, the date enter into the continuous discharge certificate CDC in respect of joining the ship 16 July. Date enter into a continuous discharge certificate in respect of signing off from the ship 19 July. So what I said, so he is joining as a crew of a ship. He's an Indian citizen. So this day, this period, 16 July 2025 to 19 Jan 2026, shall be deemed to be stayed outside India. So if you see the answer, also the ship is in international traffic. So it's roaming international traffic. It's qualified as an eligible voyage. So if you see the days, 16 July. So days is 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. 16 days of the July. Then August, September, October, November, December, and 19 days of Jan. So this aggregates to 188 days. So he was not in India for 188 days. So he was in India for 177 days. Now he's leaving India to join an Indian ship. The second condition shall not apply. He will qualify resident only he satisfy the first condition. So he has to be in India for 182 days or more. He was in India for 177 days. So he qualify as NR. The fact that he was in India for 415 days in the previous 4 years or 745 days in the previous 7 years, not relevant. It doesn't satisfy even the basic condition. So we will not come to the additional condition. So he is non-resident for AY 26-27. You are with me? Okay. And out. Now we can move to the second question. Chris Gale, a West Indies cricket player, visit India for 102 days every financial year. So he comes to India for 102 days every financial year. This has been his practice for the past 10 financial years. So he's following this for the last 10 years. He's coming to India for 102 days in each year. Okay. You have to compute the initial status for 26-27. So for the current year, he was in India for less than 182 days, but he was in India for more than 60 days. He was in for 102 days. And the last 4 years, he was in India for 408 days. He comes for 102 days every year. Okay. So he satisfies the second condition. He qualifies resident. Now the additional condition, was he resident in at least 2 out of last 10 years? Yes, he qualifies resident. In the last 7 years, he was in India for 714 days. I need 730 days. So it doesn't satisfy the second condition of the additional condition, and therefore he qualifies as R and O. Let's see the answer. He is not ordinary resident. Satisfy condition number 2. He is not ordinary resident. Would your answer change if the above fact relate to Srinath, an Indian citizen who resides in West Indies and represents West Indies cricket team? Now see, now he's an Indian citizen. He's coming into India 102 days for a visit. So he qualifies as he settled outside India. So he qualifies as a third person. For the third category of person, the second condition is not applicable. He qualifies resident only if he satisfies the first condition, which is 182 days or more. But he's in India for 102 days. But now you have to also see whether his Indian income is more than 15 lakh or up to 15 lakh. But this fact is not relevant because even if his Indian income is more than 15 lakh, he has to stay in India at least 120 days, even after the amendment. But he's in India for only 102 days. So therefore, irrespective of the fact, his income, whatever his income, Indian income, it may be 15 lakh or more, he will qualify as NR. What would be your answer if Srinath had visited India for 120 days instead of 102 days every year? You got the point. Now, he has replaced the 102 days by 120 days. Why? To bring me into the amendment. So now, he will be resident R, NOR, if his Indian income exceeds 15 lakh. If his Indian income is up to 15 lakh, he will continue to be NR. This is a very simple question. Jet, an American tourist, come to India for the first time. Will he be deemed resident? Okay. Our question is, will Mr. Srinath is a deemed resident? Can he qualify as a deemed resident? In spell Srinath. Yeah, I got it. See, for deemed resident, we have to say he's not liable to tax in West Indies as well. There is nothing in the question which indicates that he's not liable to tax in West Indies. And therefore, it's not, the question is not towards the fact whether he's deemed resident or not. The facts are not given in respect of that. So we will not go into deemed resident even for the question's sake. He will not be deemed resident because there is a tax in West Indies. West Indies is not a tax haven. Okay, good. Question 3. Jed, an American tourist, comes to India for the first time on June 2025. So Jed is an American, he is not an Indian. He comes for the first time on June 17, 2025. He leaves India on September 29 on 2025. Okay. Determine his registered status for the assessment 26-27. Very simple. Whether he stays in India for more than 182 days or 182 days or more. I'll tell you. For June, see it's written. For June is 14, July, August, September. So he is in India only for 105 days, 105 days. So he doesn't satisfy the condition, first condition of 182 days. Does he satisfy the second condition? He came for the first time. The last 4 years he was not in India. So he doesn't satisfy the second condition as well. Therefore, he qualifies as NR. Would you answer change? He is a person of Indian origin. Okay. And his total income from Indian sources for AY 26-27 is 16 lakh. Means more than 15 lakh. So he's an Indian origin who is settled outside India, who comes for a visit. And his income is more than 15 lakh. Then if his stay in India is more than 120 days plus last 4 years 365 days, then he will qualify as R, thereby R NOR. But neither in the current year he stays for 120 days or more, nor in the last 4 years he was there for 365 days. So he continued to be NR. He will be non-resident. Okay. I think it's the last question for this concept. Mr. Ram, a citizen of US, resides in St. George in USA. So Mr. Ram is a citizen of US. He's not a citizen of India. The name is Ram, but he's a citizen of US. So he's in USA since 2004. He has an Indian name, but he's not an Indian citizen. He's non-resident since assessment date 2004-5. Since 2004-5, he's non-resident. Okay. He works for S Inc., a US-based company. Okay. He came to India on 10th Jan 2024 to visit his aged parents. So he's from India, but he has taken the citizenship of USA. So he came for the first time after a long gap on 10th Jan 2024. Okay. He could return back on 31st Jan 2025. Okay. He was permitted to work from home in India by his employer. So while he was in India, he was working. The detail of his earning and withholding tax during the said period is given below. So it's given for the month Jan, Feb, March, April, salary, federal tax, state tax, social security tax, and the exchange rate. Okay. He has also earned FD interest, fixed deposit interest in USA on 30th September 24, US dollar 200, tax deducted US dollar 20, and 31st March 2025, US dollar 220. TDS 22. As per Article 2 of DTAA, the taxes covered for credit are federal income tax imposed by Internal Revenue Code, is the tax department of US, IRC, but excluding social security taxes. Return of income for AY 25-26 was filed on 25th August 2026. Okay. You are required to compute the registered status. Chalo. We have to compute the registered status and comment upon the taxability of income. So he's driving two types of income, salary and the FD interest. So first, let's see his registered status. So he came India on 10th Jan 2024 and he returned back on 31st Jan 2025. So he was in India in the previous year for how many days? April, May, June, July, August, September, October, November, December, and 31st Jan 2025. So if you see, he was in India for 306 days during the relevant previous year. Okay. April, May, June, July, August, September, October, November, December, January. He satisfies the condition of stay in India for, so he's in India for more than 182 days. He qualifies as a resident. Now, whether he satisfies the additional condition, of course not. He came for after a very long gap on 10th Jan only. And it's also stated that from AY 2004 and 5, he was non-resident. So he doesn't satisfy both the condition. He qualifies RNOR. He is resident but not ordinary. Now for RNOR, what type of income is taxable? The Indian income, the income accrued, arise or received in India, of course, plus income from business controlled from India, profession set up in India. Okay. So he has two types of income. This is salary income and FD income. So of course, the FD income neither received in India nor accrued in India. It's not taxable. But the salary income, I told you. What do you mean by the income accrued in India? See, the ICAI, it's a July 21st question, exam question. So ICAI actually in the final stage tests the understanding. So what do you mean by income accrued in India? Means the income in respect of which activities are performed in India. So for earning that salary, he was in India. The activities to earn that salary was performed in India. And therefore, whatever salary he is driving for the period he was in India is deemed to accrue rise in India and is taxable in India, irrespective of the residential status. Since Ram rendered service in India, income from salary for this period will be deemed to accrue rise to him in India and will be taxable in his hands. Okay, and the FD income is not taxable. Understood? Okay, so this completes our residential status concept for the individual. Let's see the notes very fast, very quickly. We have already done all this. An individual is said to be resident. He will satisfy any one of the following two conditions. In India for 182 days or more, resident previous year, or 60 days or more, resident previous year, and 365 days or more in the 4 preceding years. Now for these three type of person, the condition number 2 does not apply. Indian citizen living in India, employment outside India. What do you mean by employment? If I'm going outside to start my own business, I'm not joining a job. Whether I'll fall into this category? The answer is yes. Employment includes self-employment. Okay, Mr. Sanjay? So next, the second category, individual citizen of India who leaves India as a member crew of Indian ship. Thirdly, Indian citizen or person of Indian origin, we discussed this, who being outside India visit India during the relevant previous year. Visit, not for the permanent settlement. In case of an individual who is a citizen of India, person of Indian origin, we are talking about the amendment. Having total Indian income exceeding 15 lakh, being outside India, visit India. Condition number 2 shall apply. As we for the word 60 days, the word 120 days have been substituted. And such individual shall always deemed to be RNOR. If its stay in India during the relevant previous year is less than 182 days. Now, the definition of income from foreign sources. It means income accruing outside India except income from business controlled from a person set up in India. Okay. Person of Indian origin, he either of parent or any of his grandparent. Okay, born in undivided India. Now deemed residency, 3 condition, Indian citizen, Indian income exceeding 15 lakh, not liable to tax. Then you are deemed to be resident in India. So in such case, you always qualify as RNOR and deemed residence applies if you qualify as NR in 6(1). What do you mean by liable to tax? Means you should be liable. There should be a liability on you in that country. Liability of income tax on you. Irrespective of the fact whether you are exempted or not. There should be a liability. You may later be exempted. I'll tell you an example. In Indian Income Tax Act, there is no tax on the person residing in Leh because the environmental conditions are so tough, so there is a benefit given. If you are residing in Leh, no tax, no income tax. Now we cannot say that these type of persons are not liable to tax in India. They are liable to tax, but they are exempted because of some conditions. Similarly, there is no tax on Sikkimese person. So like this. But these persons are liable to tax. They are subsequently exempted. Additional condition, when you are resident, you have to see whether you are ROR or RNOR. You will be ROR if you satisfy both these conditions. Resident in at least 2 out of last 10 years. In last 7 years, you were in India for 730 days or more. Now, the eligible voice concept. If you're an Indian citizen, you're joining a ship as a crew member, then following periods not considered as a stay in India. Period enter into a CDC for joining and enter into a CDC as signing off from the ship. Eligible voice means the ship is engaged into the international traffic, means the originated port in India, then a destination port must be outside India, or originated port outside India, then destination port must be in India. Okay, so this was the concept of residential status of an individual. Now we'll do with the other types of person, the HUF. So now other types of person are artificial person. They cannot physically stay in India because they don't physically exist. So this type of condition can't apply to them. So what the law says for them, they will be deemed to be resident in India if their control and management for all this type of person, if their control and management is in India, then they will be qualified resident in India. If whole of the control and management outside India, then they will qualify as non-resident. So for HUA, is said to be resident if any part, even a single decision, any part of control and management of its affair is situated in India during the relevant previous year. So what do you mean by control and management? Control and management means the brain, where that actual decisions are taken. It's different from the place where decisions are implemented. You remember that Dubai example. So decisions were taken in India, but flats were built outside India. So where the decisions are implemented are not relevant for deciding control and management. Where decisions are implemented relevant to decide where the income accrues. But now we are seeing where the control and management exists. So where it resides where the decisions are taken. So even a single decision is taken, any part of control management is in India. For an HUF, if even a single decision is taken in India, that HUF shall qualify as resident for such year. To qualify as NR, the whole, if wholly, a HUF is said to be NR if control management of its affairs wholly situated outside India. To qualify as NR, the whole of the control management should be outside India. Okay. In HUF as well, there is a concept of ROR and RNOR, but the conditions are same, but we have to check that condition qua karta. So if the HUF qualifies as resident, if any part of its control management is in India, then we have to see whether the karta qualifies the additional two conditions. He was resident in India for at least 2 out of 10 years, and he was in India for 730 days or more during last 7 years. If we satisfy both these conditions, then HUF becomes ROR. If we doesn't satisfy even one of the conditions, then the HUF becomes RNOR. Okay. This was the residential status of a HUF. Now, for all other persons, there is a concept of either resident or non-resident. The concept of ROR or RNOR was only qua individual and HUF. See, I have prepared a small chart. See, for individual HUF, an individual HUF either be resident, but if he is a resident, he will either be ROR or RNOR, or he may be NR or he may be deemed resident. In case of deemed resident, he will always be RNOR. Okay. For all other persons, they will either be R or NR. There is no concept of ROR or RNOR. Okay. So now, for registrar of HUF, if control management of its affairs situated wholly or partly in India, if yes, then it's a resident. then you have to see whether the culture satisfies the two additional condition. If it satisfies both the conditions, then the HUF is ROR. If the culture doesn't satisfy even one of the condition, then the HUF is RNOR. If not even a part of control management is in India, then the HUF is non-resident. Now for the other entities, other than individual, HUF and company. For all other entities, the provisions are same as that of HUF. If any part of control management of such entity, say a firm, LLP, local authority, whatever, if any part of its control management is in India, then that entity is resident. If whole of the control management is outside India, then that entity is non-resident. And if you are resident, then your global income is taxable. Okay. So concept is same. Why we are studying resident, non-resident is to understand what type of income will be taxable in India. Now we'll move to the residential status of company. This is a new concept for you. Okay, you have not studied in IPCC. So what is say? A company is resident if it's an Indian company. So if you are an Indian company, means a company incorporated under the Companies Act 1956 or 2013. If you're a company which is incorporated in the Indian Companies Act, then by default you are a resident company. Your global income is taxable. Full stop. You don't have to see where the control management is there, where the operations are being done. If you're an Indian company, means a company incorporated in the Indian Companies Act, either 1956 or 2013, as the case may be, you are a resident company. Your global income is taxable. But if you're not an Indian company, means you're a foreign company incorporated in a foreign law, then also you can become a resident if your place of effective management, POEM, in that year is in India. So for a company, you'll be a resident. Either you are an Indian company, or if you're not an Indian company, means you're a foreign company, then you have to see where's your POEM. POEM means place of effective management. We'll do this in detail. So where is your POEM? Wherever your POEM is, if your POEM is in India, then you will qualify as resident. As I said, residential status is a yearly concept. So we have to see for foreign companies the POEM every year. It may happen that for year one, the company qualified resident in India because its POEM was in India. But in the next year, it shifted the POEM and therefore it qualified non-resident. Okay, we do this in detail. So for how you determine the administrative status of a company, is a company an Indian company? If answer is yes, then you are resident, the company is resident. If answer is no, then you have to see where the POEM is. Whether POEM of the company is in India during the relevant previous year. If answer is yes, then you are resident. If answer is no, then you are non-resident. So for a non-resident, you have to be a foreign company, means both the conditions should fail. You should not be an Indian company, must means you're a foreign company, and your POEM should also be not be in India. Okay, so we'll take a 5-minute break. Then we'll start with the concept of POEM. In the concept of POEM, we'll discuss two things. The first and the most important thing, how we determine where the POEM is. And the second thing is, if the POEM is in India, then how the income is computed. There are some practical difficulties. We address all these difficulties and we'll take a 5-minute water break and then we can continue. So we'll meet 7:25. Okay. Thank you. till now we saw how we determine the residential status, what was the need of determining residential status, what happens if you qualify as R, what happens if you qualify as NR, why such provisions are there. We discuss in deep. What's the reason behind the provisions? So see, you're a finance student. The intent is you understand the concept. So it helps you in better understanding the subject. In it actually it generates interest in the subject, and also it helps you in retaining the provisions. So having an interest in a subject like taxation is very important. So my intent is always to give you a conceptual understanding so that you understand, you get an interest in the subject, and it helps you explore the subject more from your own self. Okay. So coming back to the provision of place of effective management. See, what is the intent of residential status? If you see, for the artificial entities, what the government says is that if the control and management is in India, then so the HUF, firm, LLP, whatever, you're resident in India. But for the companies, they have brought in the concept of POEM, place of effective management. It's something similar to the control management only. But let me tell you, let's go behind this for one step back. Why this concept was brought? See, first thing is that it's something similar to control management only. But the words is different, the place of effective management. We'll go in detail. And what do you think? Where does it apply? Do you think the Microsoft would have a OM in India? Or a foreign company, say Tesla or Apple or Meta, would they have a poem in India? Does the Indian government want to tax them? Of course, they have a poem outside India. Yes, correctly, Mr. Sanjay. So, what used to happen is that it's actually want to tax the Indian MNCs. I tell you, what used to happen is that there's an Indian group, Indian MNC group, say Infosys. Company like Infosys, which have a subsidiaries throughout the world. Infosys, TCS, and all this Reliance, Tata, whatever you say. So they have subsidiaries all around the world. So we call them Indian MNCs. Now, what these Indian MNCs used to do, instead of opening a foreign branch, what they do, they open a foreign company. What's the difference between a branch and a company? Can anybody tell? Branch is not a separate legal entity. It's only an extension of the main company. So if there's a company in India, it opens a branch in, say, Singapore, then a Singapore branch doesn't have a separate legal entity. It's just an extension of the Indian company as well. And company is incorporated. Yeah. So whatever the income which the branch is earning in the Singapore will consolidate into the Indian company financials only and will be taxable in India because the Indian company is resident in India. So if there's an Indian company which has a branch in Singapore, so whatever the Singapore branch is earning, that earning will be included in the financial statement of the Indian company, and the Indian company is resident, and therefore its income will also be taxable in India. So what they used to do is they open a foreign company instead of branch and wholly owned subsidiary. So there is an Indian company. There is an Indian company. It has a 100% share of a foreign company. Okay. So the entire control, but since it's incorporated as a company outside India, it's a separate legal entity. It's separate from the Indian company. Its financials are drawn separate. It has an individual, its own financial separate from the Indian company. Okay. There's a different thing that for SEBI, you have to consolidate. That's a different thing, but it has a separate, everything separate from the Indian company. So another entity, separate legal entity. Now, if such foreign company qualifies as NR, then the income of such company is not taxable in India. Reverse the NR. Understood now? So, for this reason, what the Indian company will do? It will try that this foreign company qualifies NR. Its control and management is retained outside India and therefore qualifies NR. This was a pain area. What do you think? Is it easy to determine the control and management of poem? See, if you understand very broadly, the poem is nothing. Poem means the where the brain resides. Actually, where the actual decisions are taken. You know, the key management and commercial decisions are taken. Where the brain is. It's not applicable where the hands or legs are, where the brain is, where the key decisions are taken. So, if the brain is in India, then that foreign company, even though incorporated outside India, will qualify as resident. But where the actual brain decides to determine that is a very, very factual question. And to determine that for the Indian government is very difficult. It can be determined only through search and all these facts. But it's not very much prima facie apparent where the brain resides, where the poem is. It's a very factual question. So, what this Indian company does? It tries to show that the foreign company has its own brain. But we all know that all the decisions must have been taken by this Indian company. This is what we will study in poem. But so to capture these type of companies only, the poem concept was introduced. Now, this foreign company can be resident or non-resident depending where the poem is. It's not an Indian company, so first condition is not applicable. Now it can be resident if poem is in India. It can be non-resident if poem outside India. Now let's see what the poem is. We'll discuss theoretically, then we'll discuss practically as well. So there's a definition given in the act itself. Poem means a place where key management and commercial decisions that are necessary for the wait a minute. I'm trying to hide this chat box. Yeah. That are necessary for the conduct of business of an entity as a whole are in substance made. So, poem means a place where key decisions, which type of decision? Management and commercial decision, and that is key, which are necessary for the conduct of business of an entity as a whole. So, the entire entity are in substance made. If you keep in mind, if we are talking majorly about the companies which are subsidiaries of a Indian holding company, okay, they are majorly got captured by this poem. Otherwise, we are talking about every foreign company which is not incorporated in India. So, where the poem of such company is, where the key decision, which type of decision? Management and commercial decision, which are relevant for the entity as a whole are in substance made. We discussed this definition for some time. Okay? So decisions should be key decisions. We are not talking about the routine or the regular decisions. See, key decisions means which impact the revenue flows of the company as a whole. Then also we are talking about the management and commercial decisions. We are not talking about the administrative or the regular day-to-day decisions. And thirdly, the decision should impact the entity as a whole. We are not talking about a region or a product class. We are talking about the entity as a whole. And lastly, the concept of poem is a substance over form. You don't have to see the form, but you have to see the substance. See, what will happen here? In case of the foreign company, here, what will happen? In form, all the decision would have been taken in Singapore itself. The meeting would have been held in Singapore itself. but all on papers. Actually, the reason might have been taken by the Indian company, while in India, because Indian company maintains the control. So we have to see the substance where the reason are actually taken, not the form where they are shown to be taken. Okay. So there's a guideline. The CBDT has come out. So this is a difficult question where the poem has. So CBDT has come out with a circular. The first condition is this circular is not applicable if the turnover of the company is less than 50 crores. So we are not talking about a small company. We are talking about the larger, bigger companies. So what the circular says, to decide whether whether foreign company has a poem in India or not, you have to see first whether the company is engaged in active business outside India, ABOI. So before deciding whether it's a poem or not, first decide whether the company is engaged in active business outside India. So before you decide whether the company has a poem, you see whether it has active business outside India. If answer is or no active business. If company has active business outside India, then the poem shall be at a place where majority of board meetings happen, not all. So if the total board meetings happen during the year, say 7, and 4 happen outside India and 3 happen in India, and companies engaged in ABOI, active business outside India, then the poem of company shall be outside India, because majority of the meetings happen outside India. Even if part of the meetings happen in India, no problem. If the company is engaged in active business outside India, then we have to see the majority. Part of the meeting may happen in India, but if the majority meetings happen outside India, then the company is said to have a poem outside India, provided companies engage in active business outside India. You are with me? Okay. How we determine whether the company is engaged in active business outside India? We'll discuss in a minute. So, first let's see why it's relevant. If there is no OBY, means company is not engaged in active business outside India, then you have to see two things. First, who are the persons who are taking the key management and commercial decision? What they are taking? They are taking key management commercial decision. They are taking key management commercial decisions. So who are those persons which are taking the key management commercial decision? Then you decide where such persons are taking these decisions. Okay. So if the company is engaged in active business outside India, no need, just see where the majority of the board meetings happen. If it's happened outside India, then the poem is outside India. But if company is not engaged in active business outside India, then you have to see the two things. Who are the person who are taking key management decisions, management commercial decisions, and where the decisions are taken. Okay, you're with me? See, if I tell you logically and fairly, actually it's talking about the board of directors. We are talking about the board of directors in fairness. They are the person who actually take key management and commercial decisions. They are the person who are responsible to decide to take the key management commercial decision. If everything is happening fairly. So if you see what happens, they are shareholder, then there's second layer of board of directors, then there's a layer of middle and junior management. Generally, broadly there's a structure of every company. So everything is fair. Then these type of person, board of directors, are the person who are responsible to take key management commission. We have to see where these persons are taking the decisions. They generally take the decision in board meeting. Okay. If everything is fair, then we have to see where the board meetings are happening to decide where the poem is. In fair condition, it may happen that these persons are not taking the decision and they have delegated, or the shareholder have taken this power from them. In such case, you have to see where who is taking a decision? In normal scenario, it should be board of directors. But if in fact it's not, then we have to ascertain who is taking the decision and where such decisions are taken. You with me? We are talking about poem, place of effective management, and not about place of management. So what the law says, a company may have a more than one place of management, but it will have only one place of effective management. The company may have more than one place of management, but the company will have only one place of effective management. We are trying to identify that place. Point. Okay. So what the law says? The law says is it's see this is very logical concept. Whatever we say, you will relate to that. Just listen to me very carefully. So law say if your company is engaged in active business, so it's not a shell company. It means to say, understand? It means it has a business outside India, very active business. It has a sales, income, employees, infrastructure outside India. So it gives a way to the fact that company is actually operating outside India. Then a relaxation is provided. You just see where the majority of the board meetings are happening. But board meetings, meeting of board directors. But if it is proved that board is not doing its function, means the responsibility to take key management commission decision is the board. But if it is proved that board is being aside, is kept aside, and the functions are being performed, the key management commission decisions are taken by some other person, maybe the Indian holding company or somebody in India, then in such case, even if the majority of board meeting happen outside India, the poem shall be in India. Very logical as well. See, what the law says. If you engage in active business outside India, then you see the majority of the board meetings. But of course, the law means, law presupposes, law assumes, when it says the majority of the board meeting, that the board meeting is doing their responsibility, doing the work they are assigned to, means taking the key management commercial decisions. But if it is proved on facts that they are not doing that, there is some other person who is doing that, then this, where the majority of board meeting happen, becomes irrelevant. Is not relevant to decide the poem. Now, what is relevant? Where the decisions are taken. And if it's taken in India, then the poem shall be in India. You are with me? Let's say first we have to see where the company is engaged in active business outside India. So if it is engaged in active business outside India, the poem shall be presumed to be outside India if the majority meetings of the board of directors are held outside India. You are with me? If it is established that board of directors are standing aside, means they are not doing their work, means they are not taking key management commercial decisions, means the key management commercial decisions are being taken by somebody else and not exercising their power. Who are not exercising their power? The board of directors, which are being exercised. Now, who are taking the decision? Indian holding company or any other person resident in India. So if there is some other person who is resident in India or Indian holding company who is taking the key management commercial decision, then of course the poem shall be in India. The poem shall be considered to be in India. Then the majority of the meetings held outside India is not relevant. Even all of the meetings even have outside India is not relevant. Why? Because I told you, the poem is a concept of substance. It's not form. The board is a form now. The decisions are actually taken by the Indian holding company. So it's only on form, on paper. It is shown that decisions are taken by board, but it's actually taken by the Indian holding company. How it is happen? See, it happens generally in a way. Assuming there is a condition, there is a requirement in such companies that every contract exceeding 10 lakh shall be approved by the shareholder or by the Indian holding company. And historically, 99% of the contracts are more than 10 lakh. Then, of course, board is doing nothing. The reasons are actually whether take the contract or not taken by the shareholder. Then, even if there's an active business outside India, the the relevance of meeting having outside India is not, it has no relevance. The majority meeting having outside India is no relevance. Where this shareholder is seated is relevant to decide the poem. Okay? I'm trying to explain you with the practical concept. Now, if the company is not engaged in active business outside India, we're talking about the other cases. For other companies, means companies who are not engaged in active business outside India, poem shall be determined on the basis of location of person taking key management commercial decision. Very logical. You don't need to remember. Everything is very logical. Even if it had not been there, you will assume it's same. If company is not engaged in ABOI, active business outside India, then where's the poem? Poem is a place where the key management decisions are taken. If such decisions are taken by the board of directors, the poem shall be at the place where board regularly meets. It may happen that board may delegate its power, its authority to take the key management decisions to a senior manager, or to shareholder or to a legal or financial advisor. It may happen. If such decisions are taken by senior management or any other person, including shareholder, promoter, strategic, legal, or financial advisor, now the poem shall be at a place where senior manager, such other person, make those decisions. If such decisions are taken by executive committee, it may happen that the decisions, a committee is formed to take such decisions. Then the poem shall be at a place where the members of the committee are based. Very logical. So in all this, you will see where the decisions are being taken shall be the place where the poem is. If the decisions are taken using modern technology without physical presence of the person, then the poem shall be the place where such person who are taking the decision resides. Where the person taking decision, a majority of them usually reside. What happens if people are not physically meeting and they are deciding through VC or through phone, whatever? Then where the poem is, where they reside, or majority of them reside. Physical location board meeting may not be relevant. If decisions are taken through circular resolution or round robin voting, where parties involved in those decisions are located. So whatever be the case, you don't remember all these things. These are all illustrative. Whatever be the case, the poem shall be at the place where the person is taking the key management decision, whoever that person may be. If that person is board of director, then poem shall be the place where the board meetings are happening. If such person is some other person, then the poem shall be the place where such person is taking the decisions. Okay. See, it's a very practical concept. There may be a situation that is not clear where the poem is. In such case, the law says, if above factors do not lead to a clear identification of poem, following secondary factor are considered. You can consider following factor as well. Where the main and substantial activity is carried out, where the actual activities are being carried out, and where accounting records are kept. These are only suggestive. These are not exhaustive. See, poem is a concept you have to see for the entire year, where the key management commercial decisions are taken. It's not a snapshot approach. You don't have to see one decision. You have to see actually, factually, where the key management decisions are being taken. Okay, considering all the relevant factors during that year. Now we are coming to active business outside India. So we discuss what is active business outside, why this active business outside India is relevant. Because if there is ABOI, then we have to just see the majority. But if there is no ABOI, then we have to see two things: who are taking decision and where are decisions being taken. If there is ABOI, then the work is very small. You have to just see the majority of the board meetings happening. Then the revenue, the department has to prove that board is not doing its functions only on form. But that's secondary thing. First, you have to see where the majority of the meetings are happening. So Now we will see when we say that a company has an active business outside India. A company is said to be engaged in active business outside India if its passive income is not more than 50% of total income. So if the passive income is up to 50%, so a company is said to be carrying on active business outside India if it satisfies all the four conditions. There are four conditions. You have to satisfy all the four conditions. Then you'll be said to have a active business outside India. If you don't satisfy even one of the condition, then it will be assumed that you don't have a active business outside India. Okay. So first condition is the passive income should be less than should be 50% or less. The passive income should be 50% or less. Second condition is what is passive income? We will discuss in a minute. Second condition is the assets in India. Assets in India should be less than 50% of the total asset. Third condition is employees in India. Means employees who are resident in India or who are situated in India. In any of the case. Either the employees may be resident in India or he may be situated in India. If it is employees are less than 50%. So the total employees. And last condition is the payroll expense on these employees who are resident and situated in India or situated in India is less than 50%. So what does it prove? The more than 50% of the business is outside India. And therefore we say the company is engaged in active business outside India. So what it says, a company is said to be engaged in active business outside India if passive income is not more than 50% of total income, less than 50% of total assets are situated in India, less than 50% of number of employees are situated in India or are resident in India. Payroll expense incurred on such employees. Such employee means employees who are situated or resident in India is less than 50% of the total payroll expense. If you see this and between all these points. So to qualify as ABOI, active business outside India, you have to satisfy all these four conditions. The passive income should be 50% or less, and the asset in India should be less than 50%. Employees in India should be less than 50%. Payroll spent on such employees, Indian employees, should be less than 50%. If you see, for the second, third, and fourth conditions, less than 50%. But for the first condition is not more than 50%, means 50% or less. So for first condition to satisfy, even if the income is passive income is 50%, it satisfies. But for the second, third, and fourth, if the assets are 50%, that's not satisfied. It should be less than 50%. You're with me? So for the second, third, and fourth, the asset or employee or expense in India, payroll expense in India, should be less than 50%. And for the passive income, it should be 50% or less. You got it? You understood the difference? Okay. Now let's understand the meaning of this term. What do you mean by total income? I said the passive income should be 50% or less than total income. What do you mean by the total income? Total income means the income, taxable income as per the, in accordance with the law of the country in which company is incorporated. If we are talking about the Singapore company, so as per Singapore law, whatever the taxable income of that company is, we mean total income. Or if there is no tax in Singapore, it may happen that Singapore is a tax haven, maybe a tax haven, maybe there may be a country who is a tax haven. So in such case, the total income means the income as per books of account. So everything is very logical. Total income computed in accordance with the law of a country of incorporation or as per book of account where the above computation is not required in such country. Now, passive income. So this passive income should be 50% or less than this total income. You are with me? What do you mean by passive income? Passive income means aggregate of income from transaction where both purchase and sale of good is from or to its AE. AE means associated enterprise as per the transfer pricing regulations. Should the passive income, oh, good point, Sanjay. So he's asking, should the passive income in India or outside India? So good concept. For passive income, it's not relevant whether the passive income is in India or outside India. If you see for the second, third, and fourth condition, it's important that the assets or the employees are in India. But for the first condition, passive income, it's not relevant whether the passive income is from India or outside India. See, why it's not relevant? Because, good you ask, because you can have passive income irrespective of the jurisdiction. What may happen, what actually happen practically, what these Indian MNCs do, they form a company outside India for investment. For investment, say for investment Asia Pacific region. So whole of the income of such investment company is generally from dividend capital gains. These are passive income. So to decide on the affairs of this passive income is not relevant to be there. You understand? If you are an active business outside India, it gives an impression you must be there. The decision-making authority must be there to carry on such business because practically generally not possible if you're an active business outside India and you control it from India only, majorly. So for that reason, but if you all have the only the passive income, then you can do it from India. So therefore, there's no concept, there's no requirement that passive income should be in India. If you see, they'll only say the passive income should not be more than 50%. For other three conditions, it said in India, the payroll spends on such employees. Okay. So what is the passive income? Passive income means the income from transaction where both purchase and sale of good is from or to associated enterprise. So both the things. You are purchasing from your associated enterprise, from your related party, and you're selling it also from the to the related party. What you are doing? Both are related parties, they can do themselves. You are shell company, you're doing something which is only for tax purposes. So that's why. Secondly, the core passive income, which is income by way of interest, capital gain, dividend, royalty, and rent. So all these income are by nature passive income. But interest income shall not be considered as passive income in case of company which is engaged in the business of banking or as a public financial institution. Of course, for the bank, the only income, the active income is the interest income. So aggregate of A and B is the passive income. A is income from transaction where the goods are purchased and sold, both the things, to the A, or the income in the nature of dividend, capital gain, royalty, interest, and rental. So the aggregate of this income should not more than 50% of the total income. Okay. Now we come up to the assets. So how determine the value of the asset? In case of depreciable asset, the average of the opening and closing WDV. In case of depreciable asset, whether individually or as a block of asset, whatever the law is there in the country of incorporation. If they give individual depreciation, then you take the value of the individual assets. If they give depreciation as a block of asset concept, similar to what India has, then you aggregate, you took the average of the block of assets. Average of tax WDV at the beginning and end of the previous year in the country of incorporation, as per that country. In case of any other asset, WDV as per books of account. Okay. Number of employees. Now, who are employees? Employees shall include persons who, though are not employed by the company, perform tasks similar to those performed by employees. So we're talking about the contractual employees. The employees shall also include the contractual employee consultant, which are not on the payroll of the company, but they do everything what the employee does. So we're talking about substance, not the form. Again, average of number of employees at the beginning and end of the year shall be considered. Okay. Now payroll expenses. It means cost of salary, wage, bonus, and all other employee consideration, including related pension and social costs borne by the employer. So whatever the company is bearing on account of that employee is included as a part of payroll expense. Okay. Now, the law says all these figures were for which period you have to see the average of data of the previous year and two preceding previous year shall be taken into account. So if you determine the poem for say financial year 24-25, so you will see the data of 24-25, 23-24, and 22-23, and you take the average of these, and then you will see whether the 50% condition is satisfied or not. But if the company was in existence for shorter period, if the foreign company is in existence for less than 3 years, then data of such period shall be considered, of course. Okay. So you understood? What do you mean by ABOI? ABOI means you have to satisfy the four conditions. The passive income should be 50% or less to the total income. The asset in India should be less than 50%. Employees resident or situated in India should be less than 50%. The payroll expense on such employees should be less than 50%. If all these conditions are satisfied, then you qualify as a ABOI. When you qualify as a ABOI, when the foreign company qualify as active business outside India, then we see where the majority of the board meetings happen. If majority of the board meetings happen outside India, then the poem is outside India, full stop. But if somebody proves that board is setting aside, is not doing its function, then we see who is taking the decision and where the decisions are taken. Similarly, if the company is not engaged in ABOI, means if it does not satisfy any one of these four conditions, if it even does not satisfy one of the condition, it will be deemed it is not engaged in active business outside India. Then in such case, we have to see who are taking decisions and where the decisions are being taken. Okay, you are with me? General principle. If it is determined that during the previous year poem is in India and also outside India, then poem shall be presumed to be in India if it is mainly or predominantly in India. Understood? I told you we have to see all the relevant factors for the entire year. It's not a snapshot approach. Don't see one decision, one meeting. So all the relevant factors for the entire year, where the predominantly the decisions are being taken, the important decisions are being taken. See? Okay. See, having a poem in India for a foreign company is a big concept because now the global income of the foreign company shall be taxable in India. So it says there should be checks and balances. The AO, tax officer, cannot on itself decide whether the foreign company has a poem in India or not. He has to take a approval of a collegium of a committee consisting of 3 officers of the rank of commissioner or principal commissioner. If all this committee approves, only then the foreign company is said to have a poem in India. The AO shall, before initiating any proceeding for holding company incorporating outside India, on the basis of its poem, holding a company incorporated outside India on the basis of as being resident in India, seek prior approval of CIT. So before initiating a proceeding, even asking a question from the foreign company about its poem, he has to take approval of the CIT, and for deciding, finally concluding whether the company has a poem in India or not, he has to take the approval of the committee consisting of 3 officers of the rank of commissioner or principal commissioner. Poem guideline given above shall not apply to a company having turnover 50 crore or less in a financial year. So I told it applies to a bigger company, not a smaller company. Okay. Now let's see some basic concept which we have discussed and we'll again see. The relaxation. Yeah. The relaxation is provided for the company engaged in ABOI. So if your company is engaged in active business outside India, then you don't have to apply much mind. You just have to see where the majority of the board meetings happen. And such company, even if take few key management commercial decisions in India, because part of the board meeting may happen in India, shall be non-resident if majority of the board meetings are held outside India. I struggle in placing this chat box. In case of other companies, POEM is at a place where key management and commercial decisions are taken. The company means the companies which are not engaged in active business outside India, means which does not satisfy any one of the four conditions: passive income, assets, employees, payroll expense. For passive income, condition is 50% or less. For other three, is less than 50%. I keep on repeating so that it goes in your mind and helps in retaining the things. For other companies, what you have to see: first identify person who are taking decision, who, and then POEM shall be a place where such decisions are taken. So who and where. For the purpose of determination of POEM, it is substance which would be conclusive rather than fact form. So you have to see actually on ground who are taking the key decision. It's not on papers who are taking the decision. Okay. So what happens in the global setup, a group which have a global companies, the main company, the parent company generally gives policies which are applicable for the entire group. It's for the consistency. This policy qua payroll, qua HR, qua banking relationship, qua IT infrastructure. See, if you're talking about, say, I'm talking about KPMG, a big four. So it has a presence in many countries all over the world, but all the countries follow the same color combination, have the same branding, have a same HR rules. They are governed by the senior HR, which may be sitting in US or whatever. So all these things doesn't mean that the board is not doing its function. The board is following the global policies, and such policies are for all the countries, not for specifically for a country. Then it doesn't mean that board is setting aside. So what they say, merely because board of directors follow general and objective principle of global policy of the group laid down by the parent entity, which may be in the field of payroll, accounting, human resource, IT, supply chain, or routine banking operation. So how the accounting has to be done, generally the parent company dictates that, so to maintain the consistency, and are not being specific to any entity or group of entities per se, would not constitute a case of board of directors of companies standing aside. Okay. Now, mere formal holding of board meeting at a place would by itself not be conclusive for determination of POEM being located at that place. So, substance matter. Merely holding a board of director meeting where the actual decisions are taken at some other place, maybe by some other person, maybe by shareholder or by advisor or by a executive committee, doesn't mean that the POEM should be at a place where the board of directors meet. So POEM should be at a place where the person actually taking the decision meet. If key decisions by the directors are in fact being taken in a place other than the place where formal meetings are held, then such other place would be relevant for POEM. As an example, this may be the case where the board meetings are held in a location distinct from a place where head office of the company is located. See, where the head office is located is very important to determine the POEM. Generally, the key management decisions are taken in the head office. Head office means the office, principal place of business of the company, which the company say to the public that my principal place of business is this. So the location of head office is generally very important unless proved otherwise. Head office of a company would be a place where the company's senior management and their direct support staff are located. Or if they are located in more than one location, the place where the primary or predominantly located. The head office is a place where senior management sits. A company's head office is not necessarily the same as the place where the majority of employees work, where its board typically meets. So where the employees actually work, where the activities are happening, where the decisions are implemented is not relevant. What is relevant? Where decisions are taken. The implementation, place where they implement is not relevant. The location of company's head office will be a very important factor in determining of the company's place of effective management because it often represents the place where key company decisions are made. We are discussing all this so that the concept goes, you absorb this concept. The following point need to be considered for determining the location of head office. You remember, we are discussing to identify where the key management decisions are taken. Regarding head office, it's generally believed that key management decisions are taken at head office, but the department or the facts may prove otherwise. If they prove otherwise, then the poem should be the place where these decisions are actually taken. We are talking about the substance, not the form. If company senior management is supposed to have based in a single location, and locations held out to the public as company's principal place of business or headquarters, then the location is the place where the head office is located. Okay, it just give you an idea. You know, it's all adding to the conclusion, is giving weight to the conclusion where the poem is. You have to see entirety of the facts. If the company is more decentralized means the power is distributed at various places. Various members of senior management may operate at office located at various countries. And the company's head office will be location where these senior managers primarily or predominantly based, or where they normally return to following travel or other location, or where they normally meet while formulating or deciding key management or strategies and policies for the company as a whole. The delegation of authority by board of director means the board of director is not taking the key management decision, they have delegated to somebody. Maybe DGO. DGO means there is a official communication by which they delegate this authority by means of formal resolution or shareholder agreement. Or de facto. De facto means there is no such formal communication, there's nothing in writing, but in practice, actually, they don't take decision. There is some other person who takes the decision on their behalf. They have delegated this. So whether this DGO or de facto is not relevant. What is relevant? Who is actually taking the decision? Okay. Now we are discussing what are the key management commercial decisions. Our decision to open a new manufacturing facility or to discontinue a major product line would be the example of key commercial decision affecting the company as a whole. Okay. By contrast, decision by plant manager appointed by senior management to run that facility concerning repair and maintenance of the plant, the implementation of company-wide quality control and human resource policies will be an example of routine operational decisions. So, what matter is the key decision, key management commercial decision. The repair and maintenance of a plant or a factory or the payroll, whether whom to hire or not for the staff of the company is not the routine decision. Whether to discontinue or to start a new manufacturing facility or a product line is a key management decision which affects the company as a whole. To exit a country or to exit Europe or Asia Pacific, it's a key decision. The person who are taking the decision is the person where the poem shall lie. In certain situations, it may happen that person responsible for operational design is the same person who is responsible for the management and commercial design. Okay. The place where the management decisions are taken would be more important than the place where such decisions are implemented. So, where decisions are implemented not relevant, where decisions are taken, where the brain sits. See as the poem as a human being. Human being may have two hands, two legs in different countries. So a company may have multiple hands and legs in different countries. They have offices in different countries. But a body has only one brain. So where the brain sits is the place where the poem is. Any determination of poem will depend upon the facts and circumstances of a case. It's very factual. It may be noted that entity may have more than one place of management, but it can have only one place of effective management at any given point. Okay? The above principles are not to be seen with reference to any particular moment in time. Rather, activities performed over a period of time during the previous year need to be considered. We have to take a holistic approach. In other words, a snapshot approach is not to be adopted. This everything is written in the CBDT circular. Residence is determined for each year. Poem will also be required to be determined on year-to-year basis. So I think you're getting the point. See, there are some reasons which are taken by the shareholder only. Those reasons are not relevant. See, whether to liquidate a company, to give more right to the shareholder means to change the class of the shares issued. Yeah, all these reasons, whether to amalgamate or not to another company, all the reasons are reserved for the shareholder. These are not relevant. Where these reasons are taken, not relevant. What are relevant with the key management commercial decision for the business of the company as a whole are taken. Okay. The decision made by shareholder on matter which are reserved for shareholder decision under the company law are not relevant for determination of poem. Such decision may include sale of all or substantially all of the company's assets, dissolution, liquidation, or deregistration of the company, delisting of the company, modification of right attached to various classes of shares, or issue of new class of share. So these reasons are not management or commercial decisions. These reasons typically affect the existence of the company itself or the rights of the shareholder as such, rather than conduct of company's business from management or commercial perspective. You're getting the point? You must feel that. And therefore generally not relevant for determining the company's poem. However, it may happen the shareholder involvement can in certain situations turn into that of effective management. So generally it doesn't, but it may happen that shareholder decide to take the complete management commercial decision. This may happen through form arrangement by way of shareholder agreement, or may also happen by actual conduct. So I told you it may be by DGO or de facto, not relevant. What is on ground is relevant. As an example, if shareholder limits the authority of the board and senior manager of a company and thereby remove the company's real authority to make decisions, then the shareholder guidance transform into aspiration, and such undue influence may result in effective management being exercised by the shareholder. See, we all know shareholder is different from a company. The company is run by the board of directors. But if by way of agreement or by actual conduct, shareholder take the control of the company in their hands, then where the decision taken by shareholders are taken is the place where the poem is. Therefore, whether shareholder involvement is crossing the line into that of effective management is one of a fact, the factual question, and has to be determined on case-to-case basis. These factors doesn't determine the poem. It has no relevance. Determination of poem is not based on the following factor. The fact that foreign company is completely owned by Indian company. The fact that the Indian company is a wholly owned holding company of the foreign company is not relevant because shareholder is different from the company. The fact that there exists a PE, permanent establishment of foreign company in India, means foreign company is doing business in India, not relevant. Where the business is being done is not relevant. Where the decision is taken is relevant. Fact that one or some of the director of foreign company reside in India, not relevant. Where they take the decisions is relevant. The fact of local management being situated in India in respect of activity carried out by the foreign company in India, not at all relevant. Where the decision, these are places where the decisions are implemented. I have to see the place where the decisions are taken. The existence in India of support function that are preparatory and auxiliary. If foreign company is buying goods from India for the purpose of its as a raw material or whatever, this is not relevant. What is relevant is where the key decision, where decision from where to buy the goods is taken. All these type of decisions are taken. The place, I have to identify that place. See, I told you. In case AO proposes to hold a company incorporated outside India, to hold a foreign company on the basis of its poem as resident in India, then such funding shall be given by the AO after seeking prior approval of collegium of 3 members consisting of CIT, Commissioner rank, constituted by the CCIT, Chief Commissioner. Okay, so we have done one part of poem, the major part, which is how we determine the poem. Then the questions are asked from this concept only. Next, we will do if a company is held to be a resident in India on the basis of poem, then what are the consequences? So let's first do some question to actually see how the questions are asked from this concept. Example 1. Company A company is a sourcing entity. Sourcing means it just buys the goods for an Indian multinational group incorporated in country X. So company A is incorporated in country X outside India and is 100% subsidiary of Indian company. So the fact that I am owned by 100%, my 100% shares are held by an Indian company is not relevant to decide my poem, where the poem exists. The warehouse and stock in them are the only assets. The assets of the company, of A company, is warehouse and stock and are located in country X. So my 100% of assets are located in country X. So I satisfy one of the condition of ABOI. I don't have assets in India. Not even single asset. It allows at least 50, less than 50% I can have in India, but in this case, I don't have a single asset. All the employees of the company are also country X. So I satisfy condition number 3 and 4 as well. My all employees are in country X and their payroll expense also, whatever. The average income-wise breakup of the company's total income for 3 years. Now I have to see the first condition. What is the first condition? The passive income should be 50% or less than the total income. I have satisfied second, third, and fourth condition. All my assets are outside India. All my employees are outside India. Now I have to see the passive income. 30% of the income is from transaction where purchases are made from parties which are non-associated and sold to associated. So it's not a passive income. So passive income, both the purchase and sale should be from and to the associated enterprise. So here, the purchases are from non-associated, even though sales are to associated. It shall not qualify as passive income. 30% of the income is from transaction where purchases are made from associated and sold to associated. So this is my passive income, where purchase is also from associated and sales is also from to associated. 30% of income is from transaction where purchase are from associated enterprise and sold to non-associated. Even this is not passive income. 10% of the income is by way of interest. I am not a banking company, so this is also it's a passive income. So out of 100% income, I have 40% income, which is passive income, which is 50% or less. So I qualify all the conditions. Therefore, I am doing active business outside India. In this case, passive income 40%. If A satisfies the first requirements, is on the companies engage in active business outside India. So the question was whether companies engage in active business outside India or not. The second. The other facts remain same as in example 1. As we did, everything remains same except A company has a total of 50 employees. Now it has 50 employees. 47 employees managing the warehouse, storekeeping, and accounts of the company are located in X, country X. So out of 50, 47 employees are situated outside India. So I satisfy the third condition. My employees in India are only 3 out of 50. So they are less than 50%. Who are these 3 employees? The MD, Managing Director, Chief Executive Officer, and the sales head are resident in India. Okay, no problem. I can have up to 50%. I should have less than 50% in India. I have only 3. The total annual payroll expense on these 50 employees 5 crore. my total expense is 5 crore on the payroll. The annual payroll expense in respect of MD, CEO, and sales head on the person who are resident in India is 3 crore. So the payroll expense should be less than 50% on these employees. Out of 5 crore, it should be less than 2.5 crore. But my expense is 3 crore. So it does not satisfy the fourth condition. I have the passive income is 50% or less. The assets are all outside India. I have employees in India which is less than 50%. But the payroll expense on such employees is more than 50% of my total payroll cost. You with me? And therefore, I does not satisfy the fourth condition. And therefore, I cannot be said to have an active business outside India. All the first name of active business test is satisfied as only 40% total income is passive. Further, more than 50% of employees are outside. All the assets are outside. The first, second, and third condition satisfied. However, the payroll expenditure in respect of MD, CEO, and sales head exceed 50% of total payroll expenditure. Therefore, a company is not engaged in active business outside India. Now, example 3. The basic facts are same in example 1. Same example 1. Further facts are that all directors of the A company are Indian resident. No problem. Director may be Indian resident. During the relevant previous year, 5 meetings of board of directors is held, of which 2 were held in India, 3 outside India, with 2 in country X and 1 in country Y. So, example 1, we concluded that company is engaged in active business outside India. Now, the company had 5 meetings in total, out of which 2 were held in India and 2 in country X and 1 in Y. So I have to see majority of the meeting held outside India or not. So out of 5, 3 meetings were held outside India. So company is engaged in active business outside India. Majority of the meetings held outside India. Therefore, poem is not in India. The fact that my directors are resident in India is not relevant. They may be resident in India, but actually they are taking business outside India. Meetings are happening outside India. Okay. Poem of A company shall be presumed to be outside India. The facts are same as in example 3. This example, where the meetings were held outside India. But it is established by the AO that although AO senior management, A company senior management signed all the contracts, for all the contracts above 10 lakh, the A company must submit its recommendation to B company. So, though the decision on paper is taken by the A company's management, but what the AO finds is that all the contracts above 10 lakh are submitted for recommendation by the B company. B company makes the decision whether or not contract may be accepted. So who is taking the decision? It's the B company for the contracts above 10 lakh. It is also seen that during the previous year, more than 99% of the contracts are above 10 lakh. So more than 99% of the contracts are above 10 lakh means all the contracts predominantly are above are decided by another company, which is B company. And about past year also, same trend in respect of value contribution of contract above 10 lakh is seen. So throughout the years, major of the contracts are 99% of the contracts are above 10 lakh, which is approved by the B company. And B company is a Indian company, is a holding company of A company. And therefore, even if majority of the meetings held outside India, still poem shall be in India. You with me? These facts suggest that effective management of A company may have been usurped by parent company B company. Therefore, poem of A may in such case be not presumed to be outside India, even though A company is engaged in active business outside India, majority of the board meetings are held outside India. We also concluded the same way. It will be all logical. You just have to keep in mind 2-3 things. One is who is taking the key management commercial decision and where these decisions are being taken. Or if the company is engaged in active business outside India, then the majority of the meetings should be held outside India. For poem to be outside India. Unless the revenue tax department, the assessing officer proves that board is being assigned. An Indian multinational group has a local holding company, A company, in country X. So there's a Indian multinational group, Indian group, which has a company incorporated in country X. The A company also has 100% downstream subsidiary B and C in country X and D. So there is Indian company, then there is a company in country X. Country X again has a company in country X and country Y. Okay. The place of active management of A company is in India. The place of active management of this intermediary holding company is stated to be in India and is exercised by the ultimate parent company of the group. It is Indian company. Okay. This is the fact. The subsidiaries B, C, and D are engaged in active business outside India. So the ultimate subsidiaries are actually engaged in active business outside India. The meeting of board of directors of B, C, and D are held in a country X and Y respectively. So if they are engaged in active business outside India and their majority of meetings are held outside India, then irrespective of the fact that their holding company has a poem in India, the poem of these companies shall be outside India. But where my holding company is, where the poem of my holding company is not relevant. What is relevant? Me as a company is taking decision on my own. If revenue proves that no, subsidiary is not taking a decision are actually being taken by the holding company, then there's a different story. But there's nothing in this fact. It only says the poem of my holding company is in India. Whatever. Maybe. So his poem is in India, but I'm a separate legal entity and I'm doing activity outside India. My majority meetings are held outside India. So therefore, my poem is outside India. Unless you prove that my board is setting aside, is being set aside. Merely because poem of intermediary holding company is in India, the poem of subsidiary shall not be taken to be in India. Okay. A small question. ABC Inc., a Swedish company headquartered in Stockholm, outside India. So it has a Swedish company, foreign company, which is headquartered outside India, not having a P in India. Okay. Whether it has a P in India or not P in India is not relevant to decide the poem. We discussed this. It has set up a license office in Mumbai in April 2025 in compliance with the RBI guidelines to look after day-to-day business operation in India. So what the license office is doing? Is supervising day-to-day operation. They are not key management commercial decision. Okay. Spread awareness about the company's product and explore future further opportunities. So what it's doing is advertising the company's product. Again, executing, not taking the decisions, the key decisions. The license office take decision relating to day-to-day routine operation. It has stated. They only take decision about day-to-day routine operation and perform support function that are preparatory and auxiliary. What I need to see? Key management and commercial decision. This is not key management commercial decision. This is day-to-day operation decisions, which is not relevant. The significant management commercial decisions are, however, in substance made by board of directors at Sweden. It is stated as a fact. The key management decisions are taken in Sweden. Determine the residential status of AB Inc. Of course, it's a non-resident. It's a foreign company, it's not an Indian company. The poem is not in India because license office is only taking day-to-day decision. I have to see who is taking the key management and commercial decision, which has been taken at Sweden. And therefore, my poem is not in India. ABC is a non-resident. Okay. Singtel Limited. Next question. We are doing this so that you get a flavor what type of question are being there in your module or in your exams. In exam, similar type of question only can be asked. Most likely. Singtel Limited is a company incorporated in Singapore. So it's a foreign company. It's not an Indian company. 55% of its shares are held by Godavari Private Limited, Indian company. Not relevant. Even if it had been 100%, not relevant. Singtel Limited has its presence in India also. Okay, it has some office in India, not relevant. The details relating to Singtel Limited for the PY 25-26 are as under. So fixed assets they रखे हैं. They have given fixed asset in India, Singapore, intangible other asset, income from trading, and all. Let's see what the question is. Determine the residential status of Singtel for AY 26-27 if during PY FY 25-26 8 board meetings were held, 3 in India and 5 in Singapore. Okay. So majority of the board meetings were held outside India and Singapore. Now, if I conclude that the company is engaged in active business outside India, then the poem shall be outside India, company shall be non-resident. But if the active business is in India, then I have to see where the decisions are actually being taken. First, let's see where the active business is. Then we can go ahead. So, 4 conditions. First is passive income. So, it says the figures of income are here. Income from trading operation 25 and 50. Okay. In crores. The above figure includes income from transaction where purchase are from associated enterprise and sales are to unrelated. So it's not a passive income. Income from transaction where sales are to associated enterprise and purchase are from unrelated. Again, not a passive income. Income from transaction where both purchase and sales are from or to associated enterprise. So this 5 plus 10. Sanjay ji, you asked whether the passive income should be in India or outside India. I told you not relevant. So both, even if this 10 is in Singapore, still a passive income. This 15 crore is a passive income out of 75. Then interest and dividend from investment 20 and 15. This is also passive income 35, 15. So I have a total income of 75 plus 35, 110. Out of this, I have a passive income of 30, 40, 50, which is less than 50%. So I qualify for condition number 1. Now condition number 2, the assets. I have a total asset, I have fixed assets, I have intangible assets, I have other assets. So I have a total asset of 200, 250 plus 160. So it comes to 200, 250, 160. 610. I have an asset of 610 crores. So out of which Indian assets are 120 plus 50, 170 plus 40. 310. 170, yes, 300. Wait, sorry, 210. 150, 170, or 40, 210. So they are again less than 50%. I qualify second condition as well. Now my employees. I have 70 employees in India and 90 in Singapore. So total I have 160 employees, out of which 70 are in India. So I have less than 50% employees in India. Satisfied? And payroll expense on such employees is 8 in India and total is 20. So again, less than 50% is on employees situated or resident in India. And therefore, I satisfy all the 4 conditions. Therefore, I have an active business outside India. Now, majority of the board meetings are held outside India. My poem is outside India, and therefore, I am non-resident. Single would be non-resident. You with me? Just, we have not covered this question till now. Just one more question, then we shift to the next concept. MileSync, a company incorporated in US, is engaged in development of infrastructure and providing consultancy in the same field. So I'm a foreign company, I'm incorporated in US, I'm engaged in infrastructure development and consultancy business. Okay. During the financial 24-25, its shareholder met in India for 3 times. Okay. Who met? Shareholder, not the board of directors. The first 2 meetings were held to discuss the modification of right attached to various classes of the share. Not relevant. Third meeting was held to discuss and decide about the sale of company's assets. Again, not relevant. The meeting of board of directors are held in Chicago, USA. where management commercial decisions necessary for the conduct of company are taken. So, where the key management and commercial decisions are taken, they are taken in Chicago. Shareholders are taking decisions in India, but the decisions which are taken by shareholders are not the key management decisions. They are about the existence of a company as a whole. You are required to determine the residential status of miles. I need to decide the residential status of mine. Of course, it's non-resident. See, the decision made by shareholder in India on modification of the rights attached to the various class of shares and sale of company's asset situated in India are not relevant for determination of Miles Inc.'s place of effective management because they are shareholder decisions. They are not decisions of the in nature of key management commercial decisions. Okay. Since this is an important concept, let's revise through a PPT, small PPT, very fast. Just to it retains in your mind. It focuses on substance, not form. Okay. We have all discussed this. Poem means where the brain of the companies actually function, where the real power is, not on paper. We have to see the substance. Where the poem is, the key decision, which type of decision, management, commercial, for the business as a whole are taken in substance. Okay. Traffic signal test. You have to decide who actually decide whether the company has to go, has to stop, has to change the direction. The traffic signal. Who is the traffic signal? Is it a board of director or a shareholder or some other person? Whoever it is, such person shall decide to determine the poem. Who decide go, stop, or change direction? That place is poem. It's just one or two sentences so that it hits your mind. Key management decisions. What are the key management decisions? Examples. Which market to entry or exit, capital structure, pricing policy, pricing of the product, appointment of the senior management, annual budget, who approves, is a key management decision. Routine decisions, they are not relevant to decide the poem. Payroll, accounting entry, HR administration, factory operation, they are not relevant. Like we did liaison office or do day-to-day operation. Delegation of execution allowed. Where decisions are executed, they may be delegated. But where delegation of thinking not allowed. If the delegation of thinking happens from the board of directors, then the poem shall be the place where the decisions are actually taken, where the thinking actually delegated. If board is standing aside, means board is only exist on paper. Real decisions are taken elsewhere. Then in such case, the poem shall be the place where the real decisions are actually taken. We are talking about substance, not form. So, with the example where the board is setting aside, foreign board meetings held, but Indian promoter approves contract. We did an example, 10 lakh contract. Contract above rupees 10 lakh. Poem in India. Whatever the mode of deciding, where the person who is deciding sits is the poem. Active business outside India. Then majority of the board meeting, poem. But if it is proved that board is standing aside, then this majority of board presumption break and poem will be in India if the decisions are taken by the Indian holding company or person resident in India. These are typical structures. There's a shareholder, then there's a board, then there's operational. What I have to see the board, this level, where the poem is. Not above, not below. Head office generally is normally said to be a place where the key reasons are taken. So, where is the head office? Senior management usually works, meets and returns. Strong poem indicator. This all indicates to a fact. If the technology based decision, then poem should be at the place where the person who taken decision resides. What does not decide poem? These are irrelevant factors. Place of incorporation, Indian ownership, fee in India, duty and support function in India. These are not relevant. This is just to revise you the concept. Real life illustration. Foreign subsidiary pricing strategy decided in India. Swayam India is. This is generally happens. We have a tech companies now. Tech is in very much demand. So what the Indian company do? They open a company in UK. They put one of their employees as a director in UK, one of their old employees. But entire decision of the UK company is taken by these people, which is situated in India. So this director is doing nothing. He's just a form. He's just approving the decision. He doesn't have an authority to decide on its own. So the poem shall be in India only. But if risk and strategy decided abroad, Indian office only support, then the poem is outside. So what we have to see? We have to first identify who is taking the decision. Then we have to identify the location where decisions are taken. And that location is the poem. Poem follows power, not pressure. So we are talking about substance. For the entire last 1 year, 1.5 hour, I am just trying to make you understand, make you absorb that it's the substance that matters. It's not a big concept, it's just a small concept where the key management commercial decisions are taken. Then you have to remember ABOI from exam point of view. And generally, the question which we did, a similar types of questions shall be asked in the exam. Now, the last topics. If a foreign company is said to have a poem in India, then what are the consequences? The consequence is that it will qualify resident in India, and therefore the global income shall be taxable in India. But how will you compute that global income? So what the law says, in a case where foreign company is said to have a poem in India, for the first time, the provision of Act shall apply with the following modification. So the Act provides the manner in which you will compute the income of such foreign company. You have to give the depreciation. For that depreciation, you need a opening WDB. So law says, if such foreign company is assessed to tax in a foreign jurisdiction, if it's taxable in the country of its incorporation, then whatever the opening WDB was there, we will take it as opening WDB for India as well. If it's not assessed, then whatever WDB as a books of account was there, we take it as a WDB for India as well. You don't have a choice. It's very logical. Where tax law require computation of depreciation, tax WDB as on first day of the previous year shall be considered as the opening WDB of depreciable asset for India as well. In other case, if there is no depreciation allowed in such year, in such country, WDB which would have been as on first day of the previous year, had depreciation was actually allowed as per the provision of such country. Had it been allowed, then what would be the WDB? If there is no income tax in such country, or foreign company is not assessed to tax in such country, then WDB of depreciable asset as per books of account as on first year of the previous year. Very simple. What our losses? Very simple. Same. You have to determine the losses as on first day of the previous year. You have to see when they actually occur, and you will allow 8 years from the year in which they occur. So you will allow only the remaining period. In India, only 8 years is allowed to set off the loss. So you will allow only 8 years, and also from the year in which they actually occur, not from the year in which the company constitutes a poem in India, from the year in which the loss actually occurs. Going forward, loss and amount of depreciation as per tax record shall be determined year-wise as on first day of the previous year. But if foreign company is not taxable in its country, then loss as per books of account. Brought forward loss and unabsorbed depreciation as per books of account prepared in accordance with the laws of that country shall be determined year-wise as on first day of the previous year. Why year-wise? Because I have to see the 8 years from the year in which the laws actually originated, not from the year in which the company constitutes a poem in India. Okay. Tax treaty benefit. The foreign company shall be entitled to relief or deduction of tax paid in accordance with provision section 1991. So, Indian government says that you have a resident in India. But if the company says company is in Singapore, the Singapore government will also be collecting tax from this company on global income. It will be resident in Singapore as well. So the Indian government shall allow the benefit of double taxation, and whatever tax paid outside India shall be allowed as a credit. Okay, this is important. Where more than one provision applied to foreign company as resident as well as foreign company. See, in income tax, in Indian Income Tax Act, many of the provisions applied to a foreign company, irrespective of the fact whether it's a resident or non-resident. So many provisions say it shall apply to non-resident, other than company, and to foreign companies. Okay. So whatever these provisions are, they shall continue to apply as a foreign company. Even if company has become a resident, but if there is a provision which applies to a foreign company, it shall apply to such company as well. The provision applicable to foreign company alone shall apply. Compliance to those provisions applicable to foreign company prior to becoming Indian resident shall be considered sufficient compliance to said provision. See, I told you. 194C says tax to be deducted on payment to residents. Okay. 195 says tax to be deducted on payment to foreign company. Now my company is a foreign company, no doubt, but it has become resident as well. So I have to deduct tax under section 194C or 195. So answer is 195. So even if I become a resident, the provision applicable to me shall continue to be of that of foreign company. Because you understand, the third party who is making payment to me will not be aware my poem is in India. Would be aware that I'm a foreign company, I'm a company of Singapore. But he will not know whether I'm resident or non-resident. So what's his fault if he deduct tax under section 195 as a foreign company? Because he's not aware about my residential status. He's not even supposed to know about my residential status, where my poem is. Okay. So the law says, if there is a provision which applies to a foreign company, if there is a similar provision which applies to a resident, then the provision applicable to foreign companies shall applicable in my case. Now accounting year. This is important. What happens is that there generally is a situation where the company in its home country is not following the financial year concept. Maybe there is some different year, maybe a calendar year or some different year in such country. Then how to align it? So what the law says? I tell you, what the law says is that, let's do it by example. For example, foreign company follows accounting year from 1st Jan to 31st December. Means foreign company follows calendar year. Now, foreign company become resident in India in previous year, 31st March 2025, on account of its poem in India. Now, foreign company shall prepare its P&L and balance sheet as under. For accessible to Indian Tax Authority, how it will prepare its financial statement. It follows a calendar year. So for 24-25, I need my account, but the company follows calendar year. So first, it will prepare a financial statement for the 3 months, 1st Jan 24 to 31st March 24, and then it will prepare financial statement for financial year. First apply 24 to 31st March 25. So very simple. Whatever your accounting year may be, you will prepare the financial statement up to 31st March and then 12 months from 1st April to 31st March for the year in which the poem is said to be held in India. If I follow, say, year from 1st July to 30th June, so I had a poem in 1st April 24 to 31st March 25. I have to prepare this account. Then I have to prepare account up to 31st March 24, starting from C, where the accounting year starts. 1st July to 30th June. So 1st July 23. I have to prepare the account for 9 months. And then for the 12 month in line with the Indian financial year. But for losses, the law says if this period, this 9 month period, or earlier it was 3 month period, if I was following calendar year, is less than 6 months, then you have to aggregate it with the previous accounting year. Say, I follow a calendar year. Now for 24-25, I am said to have I'm held to be a resident in India because of POEM in India. Now my losses as per calendar year is for 23, I had 100 lakh losses. For 24, I have 200 lakh losses. But I need to see my losses and from 31st March 24. For this, I will prepare my financial statement from 1st Jan 24 to 31st March 24. This period of 3 months is less than 6 months. So it will be aggregated to the preceding accounting year, which is 1st Jan 23 to 31st December 23. So my preceding accounting year will be of 15 months. This plus 3 months of 24. Means it will be for 1st Jan 23 up to 31st March 24. So my losses for this accounting year will be 23 losses for the year, 100 lakh. And this 200 lakh loss is for the entire year. I proportionate to 3 months divided by 450. So the loss will be 150 lakh. 100 lakh for the entire calendar year 23 and 50 lakh for the 3 months of calendar year 24. So for the year, as on 31st March 24, I will have a loss of 1 lakh, 150 lakh. You understood? I have to proportionate it. Why proportionate it? Because my period before 31st March 24 is less than 6 months. So it will merge with the previous accounting year. Or my previous accounting year will become 12 months plus this 15 months. And I will do the proportionate to compute the loss. So Sanjay is asking, is this required for loss only? Yes, this is required for loss only. Otherwise, for accounting, I told you, I have to prepare the financial statement from 1st April. So before that period, whatever the period may be 3 months or 9 months, I'll prepare separate financial statement for such period. Okay. For loss, I have to proportionate that loss. If I am following 1st July to 30th June, then I am preparing the financial statement for 1st July 23 to 31st March 24. Right? But this period is more than 6 months, it's 9 months. So I will not merge this with the previous accounting year. This can remain on its own. So the loss for 23 is 100 lakh, that will be. Loss for 24, 30th June 24 is 200 lakh. This is for the 12 months. I need a loss for 9 months. I'll do proportionate 150 lakh. Okay. One last concept and the important one. We have discussed all this. See, the exception, modification, adaptation referred above shall not apply in respect of such income which would have been chargeable in India, even if foreign company had not become Indian resident. There might be an income which actually arise in India. It would be taxable whether or not the foreign company is resident or not. Even if had the poem is not in India, still such income would have been taxable in India. So all this modification is not applicable on such income. And also, wait for a minute. because of this, I tell you, because of this, assuming there is a royalty income, which is the company driving from India, and this is taxable, say 100 lakhs is taxable, whether or not the company is resident or not. So it was taxable even if poem was not in India. Now, because of poem is in India, there is additional income for this year, say rupees 50 lakh. And also there is a brought forward losses of rupees 70 lakh. Now, out of these brought forward losses, only 50 lakh can be set off. The remaining 20 lakh cannot be set off against the royalty income because this was anyway taxable. You can set off the brought forward losses only on the additional income which becomes taxable in India because of poem. Had it not been a case, had you not been held to be a resident in India because of poem, then there would not be this additional income. Also, there would not be this brought forward losses. India would be getting taxes on 100 lakh. India would still get a tax on 100 lakh, whatever the case may be. The brought forward loss can set off only the additional income which become taxable because of poem. The income which was taxable even without poem cannot be set off from the brought forward losses. You're with me? And the company, though become a resident, but shall continue to remain a foreign company. And therefore, the tax rate on foreign company, which is 35%, shall continue to apply on it. It shall not become a domestic company. It shall be remain a foreign company, though resident in India. Okay. So, last question was, Peter Inc. is a company incorporated under the laws of USA. It's a foreign company. The value of its global assets are 50 crore. Okay. The value of asset in India are 25 crores. So it's not less than, it's a 50%. But I need less than 50% in India. ABOI condition is not satisfied. Even one of the conditions not satisfied, then the company cannot be said to have active business outside India. Okay. His turnover during the previous year 24-25 is US dollar equivalent to 90 crore. Okay. Out of 10 board meetings held during FY 24-25, only 4 meetings are held in India. Not relevant, sir, because company is not having a active business outside India. The key management commercial reasons are for conduct of company business as a whole, however, made by directors located in India at the meetings held in India. So it's saying that company has a poem in India because key management reasons are taken in India. Your client, Payal Limited, an Indian company, wishes to remit an amount towards professional fee to Peter Inc. on which tax is required to be deducted in India. Okay. So there is my client, an Indian company, which is required to make a payment to a foreign company which has a poem in India. Means Indian company is making a payment to a foreign company which qualified to be a resident in India. Okay. Determine the residential status of Peter Inc. So is a resident in India. We just concluded because key management commercial reasons are being taken in India. Advise Payal Limited as to whether tax on fee for professional service has to be deducted under section 194J or 194. Clearly, perfect, Sanjay ji. It is 195 because the company remains a foreign company, and whenever there are two provisions applicable, the provision applicable to foreign company shall apply. So see, I made a good observation. The provision specifically applicable to foreign company shall continue to apply. We are talking about a company which held to be resident in India because of poem. So, provision which are applicable to foreign companies shall apply to such company. Provision which are applicable to non-resident person shall not apply now because now it has become resident. The provision specifically applicable to resident shall apply. And if there is a conflict between one and third, then provision applicable to foreign companies shall apply. You are with me? Okay. So this completes our concept of residential status, where first we discuss about the individual, just to set the background, set the tone. Then we thoroughly discuss about the poem. Hope you understand. The first part of poem where the poem is, whether the company is resident or not, is more important. And second part is very much logical. The only important point is accounting year and the losses. And this point, if TDS shall continue to be deducted under Section 195, the company shall continue to be taxable as a foreign company at the rate of 35%. It shall not become a domestic company. Any question? Hope you understood the concept which I want to share. This completes our class for today. So let's meet in the next lecture. Okay? Okay. Thank you. Thank you and Happy New Year to you too, Sanjay ji, and to all of you. Thank you. Yes, sir.